basic volatility, why I look at it, and understanding some easy tools to on how to evaluate what the market is showing you. What I have learned watching my students here over the years. So I've been teaching retail now for 11 years. I taught floor traders 15 years before that, as a floor trader myself for a long time. So the thing is, the whole point of this is to get you to start to look at options the right way. Meaning, instead of what you think is going to happen, which is great, your opinions are all lovely, they're lovely, you want to evaluate what the market is telling you. That's the reason we teach volatility at Option Pit to our students, and one of the reasons that it sets us apart. So today we'll talk about distribution, volatility, the different types of volatility, calculating realized vol. We have a spreadsheet for that. It's a question of, I believe it's already on the website, but I'll show you how to use it. It's very simple. Basic definitions of skew and term structure. This is where edge for retail traders live, but we'll mostly just be talking about what they are and why they're interesting as a trade, and then how to actively look for vol spreads. All right. But after this course, you'll understand why we care. Right. So what I would say to you is, if you have a question, that's great, but I'm going to take the questions at the end. So you can post your question, but I'm not going to get it till later because I want to get through a lot of information. Okay. So the first thing is describing how stocks move. So again, from my experience, whatever you can believe I have experience or not, I don't care. But I was a floor trader for a very long time. Okay. Stocks go up and down. What I'm trying to figure out is what that range is every day. It's going to go up a little bit today. It's going to go down a little bit tomorrow. What we assume is that stocks have an equal chance of moving up or down at any given time. Now, that's an assumption that's important to make, because sometimes we have opinions that saying clearly we don't think that's going to happen. But when you're looking at evaluating option prices, this is the assumption that is made, that stocks have an equal chance of moving up or down at any given time. Now, that is described by a normal distribution. So the movement of the stocks is, okay, it's a little up above the mean, it's a little bit below the mean. There's going to be some average number that they move. And you can describe the range of moves. Okay, most of the moves will be within 68.2% of the average or the mean. 95.4%, which is by and far the most, will be 2 standard deviation, what they call 2 standard deviations away from the mean. 3 standard deviations away, which is a common phrase, is 99.7%. So what you have is, once you're inside of 1 standard deviation, it's going to be most of the moves. 2 standard deviations is going to be 95% of the moves. What this also means is that there is always a chance for stocks to do something you don't expect. That's, again, from experience and understanding this curve. You can provide for 99.7% of what you think, right, is an outcome. But you still have that ability for things to go off the side. So again, understanding a normal distribution of movement, the market always says there's that shot. Okay, so just be mindful of that. And that's where risk management comes in. Now, from a normal distribution, when it moves in a range, we call it a variance. These are just some statistical terms. I don't want you to get bogged down with the terms, because we're going to move to something that is easier to understand to trade. But the idea is the idea of variance, right? The statistical term variance means you just have a data set and you're trying to understand how much it's going to move most of the time, or how much that data set is going to change most of the time. It's giving you an expectation of basically what's going to happen. Now, as traders, we use variances all the time. Of course, you can guess what variance is going to become. We're just moving from a distribution to a variance to a volatility. Okay, that first normal distribution underpins the assumptions that I make on how things move from a mean. Every day you walk in, how much is the stock going to move? It's the first thing I say in all my classes. What do you think the stock's going to do? Well, I got an idea what it's going to do because this is what it just did. Now, again, another statistical term, standard deviation is the square root of variance. So when we do our simple calculation, this is where the ideas come from. It's just all statistics. But I don't want you to get bogged down in the weeds of the statistics, okay? And all of the people that have ideas of, there are lots of ways to run statistical analysis about volatility. Tons of ways. What I'm giving you here is what I'm going to call back of the envelope, easy vol. Ways to look at the screen and understand what the vol is telling you, what the volatility numbers are saying, and what to expect. Do not get caught up in the weeds of volatility. Okay. Now, volatility is another word, again, for statistical term for variance. Really, volatility is standard deviations, which is the square root of variance. But the idea for volatility in your head, it represents an expected range for a stock or index on an annualized basis. This is important because this is what the option model wants, an annualized number. So the option model assumes all those little blinky lights you see on your screen with all those option prices. The initial model, Black-Scholes model, assumed it knows the volatility for the next year. When they designed that model, that was a big assumption. Now, everybody in here and everybody watching this video probably understands that nobody knows exactly, maybe except for Citadel, what the volatility is going to be over the next year on average for 1 year. So that's a thought for you to put in your head. What I want for, if you're just learning about volatility, just learning about options, you want a simple expression for trading, a simple expression for volatility based on statistics. Now, all of that stuff about standard deviation and variance, you can forget now, because now you want something simpler. Okay. Now, the easiest way to understand this is, again, on an annualized basis. Think Black-Scholes. If you have a $70 stock with a 20% volatility, what do you expect it to move? So, okay, basically, one standard deviation is roughly 2/3 of the time. That's going to be $15. 20% of $75 is $15. Just the simple arithmetic. Again, on an annualized 1 year basis. 95 times 2 standard deviations, I'm just going to add that move together. So instead of a $15 move, I'm going to have a $30 move. So if you have a stock that's a 20 volatility, what is a 2 standard deviation move on a 20 volatility? Is $30. So that's giving you the idea of, okay, if it's $75 and then you expect the stock to move $30, right? That's a pretty big range, even at a 20 volatility for 1 year, right? Because you can move 20, $30 up, $30 down. Oops, sorry, $15 up, $15 down. And for your 15 vol, it's going to be $7.50 up, $7.50 down. Now, the idea is here, how do you take your annualized number and you turn it into a non-annual period of time? So the idea is, okay, volatility is great for a year, but I'm only trading for $3 for 3 days or 4 days or 5 days or 1 day. So if I'm trading for 1 day, how do I take that simple equation that's basically giving me how much the stock can move, right? Because that's essentially giving me my range, both sides of the standard deviation. And now I want to translate that into, let's say, 1 day. So if I have a 16 volatility stock, again, remember, standard deviation is the square root of variance. I'm going to take the square root of, right, 1 over 256. Why do I use 256? That is the number of trading days, and it squares easily to 16. So the number of trading days normally is 252. If this is good enough for Natenberg, it's good enough for me. So what this does is this calculation, you could use any volatility, any amount of days as a fraction of the year. So you take the square root of that number, you multiply it times 16, and you will get how much you expect it to move. Remember, I'm not answering your questions, and I'm totally ignoring you until the end of this presentation. Again, trading days. Can you trade on the weekend? No. Okay, you only trade during the week. So what this tells you is what? A 16 volatility. If a stock trades at a 16 volatility, you expect a 1% move per day. So again, use this calculation. You see a volatility on whatever your platform is. You want to hold the thing for 5 days, 10 days, or whatever. You plug it into the formula, and it gives you the percentage move you expect over that period of time based on the vol. So you take your 1% and you would multiply it times whatever the stock number is, and you're going to get an idea of how much things are going to move. So what I'm doing here is giving you the idea of how much a stock can move based on the volatility and the amount of days you're going to hold. So we have a volatility, we have a time to hold, and we're going to have an underlying price. Now, using these things is going to help you price what the market thinks is going to happen. Right? And the idea is most of the time, one standard deviation move is going to be 68% of the time, 2 standard deviation move, 95% plus. Also, what it means is you can stack volatility up. 32 vol will be 2%, 48 vol, 3%, right? Based on our example above. So it's a simple way to understand volatility based on a range. You create some simple math, and now you have a simple number to help you understand how much something can move. You also know it is never 100%. It's always an estimate. Now, we can use this calculate in several ways. Again, I like it for butterfly wings, understanding the straddle. Again, if you don't know what those terms are, we're going to talk about them in a little bit. Now, again, here on volatility, there's all kinds of vols. What is current volatility, forward vol, implied volatility, historical or realized vol? So current volatility and historical vol are kind of similar. The idea is these are basically the 4 volatility buckets, and all kinds of volatility fits inside them. So we're going to describe current vol, forward vol. Basically, current vol, how much the underlying is moving now. Forward vol is how much the underlying is moving in the future. Implied volatility, what the options are priced as. And historical volatility is basically an average of a period of time in the past. So these are basically the 4 volatility buckets when we talk about them. So the hardest thing when you're first learning is like, what volatility am I seeing? What is it? What is it telling me? All right. So hopefully this will describe this. Now, why is volatility trading interesting? The idea of reversion. Again, there's lots of information about reversion out there. And when you're looking at this, you're trying to figure like, what is reverting to the mean, right? The idea of volatility is it just doesn't go in, again, the easy way to think about it is it just doesn't go in one direction forever. You can have that outlier move, but eventually what happens is the idea of volatility or the idea of reversion is it's not like buying Apple 10 years ago and it goes up 10,000%. It tends to revert around a mean number. So if you think about it, stock is up 1% today, down 1% tomorrow, right? You're going to get some kind of a mean. You're not getting basically a straight line up or a straight line down. It'll feel like that for a while, but it cannot stay like that for a while. So the nature of volatility means it's going to hover around an average, which is why it is interesting to trade. Because the vol goes up and then she goes down. The vol goes down, then she goes up. So it's the way it trades that makes it interesting if you choose to learn more how to do it. And this applies to all types of volatility that can be measured. Any commodity, any stock, the dollar, whatever, right? Essentially, if you can measure it, you can create a volatility around it. If it has a range, you can price it. So it's a skill you can use for many things. Now, current volatility, just how much the stock is moving now. Like when we're doing this, and today is Thursday the 28th, like we have these spikes, these end of day spikes, right? That's giving you an idea of the current volatility. So VWAP, value weighted average price, right? So again, this is kind of a reverting thing. You have a VWAP, stock goes down, right? And then again, either the VWAP gets lowered or the stock goes back to the VWAP. It's giving you an idea of, again, a reverting type of number. Short-term time periods. So in Edge Hunter, we create 3-day vol, 5-day vol, 7-day vol, meaning this is just the volatility we have had over a period of time. Okay, if you're going to trade something for 1 day or 2 days, is it nice to know how active the stock was or how much it moved the previous 3 days? Again, for me, after trading for a long time, I like that information. It gives you context. Again, daily range is what I would call ATR, how much basically the top or bottom of a wick of a candle. What was the top price or the bottom price? These are ideas. These are different current volatilities. Now, is that helping you? I don't know. But what it's giving you is you can price or trade different types of volatility. And there's gurus here and there that have ideas about volatility. Whatever. I don't care. You just have to understand what they're actually trading. Okay, forward vol. Forward vol is what Black-Scholes wants. What is the volatility between now and the end of, until, let's say, expiration? Let's make it useful, right? So nobody knows what that is, but you can estimate what it is. So it's impossible to know it exactly, but you can estimate. That's why we use volatility charts at Option Pit, right? I use volatility charts for 15 years because it gives you an estimate. And then all of a sudden you have what an estimate for volatility is. It cuts the world down to an infinite amount of possibilities to a relatively finite amount of possibilities. You can price a finite amount of possibilities. I think having this massive amount of choices to price makes it very difficult. So it brings the world down. So having an understanding of what you think forward volatility is just like, where's the stock going to go? So it's giving you, again, an idea. So what do we use? We use volatility charts, and we try to weigh all the different types of risks, right? Because once you hold a position overnight, anything can happen. Now, statistically, right, because now we're talking about statistics, you have a probabilistic move. If you know what the volatility has been over the last week, you get an idea, but still anything can happen. But forward volatility does include all of these risks. It includes overnight, weekend, intraday, whatever you can think of, right? A ship hitting a bridge, right? All these things that will end up being in a forward volatility number. Now, implied volatility. This is when we're talking about option prices. So the 5 factors that make up the Black-Scholes model are price strike, time to expiration, cost of carry, which is interest rate and dividends, and volatility. The one thing we don't know is the vol that goes in the model. So we have to guess it. Every vol you see is a guess, but option prices are based on what people actually want to pay. Remember that when you see option prices on a screen, that is what a liquidity provider will buy and sell at. Those are real prices. Just like you go to McDonald's and you go up there and there's a Big Mac is whatever it costs now. It's $5 or $6 or some ridiculous price. That's a price. That's a signal. Option prices are a signal. You use the model to back out the implied volatility from the price. So you start with the option price, you get the implied volatility. Implied volatility is always today's trade date. Today is March 28th. Implied volatility will be calculated on today's trade date. It's an important distinction to remember. Now, because implied volatility is an output and we're sticking it back in the model, we know that the model or the option prices you see based on implied volatility are just guesses. So why do we trade volatility at Option Pit? Because we know they're all guesses. And once you know something is a guess, you can also make decisions about whether you think the guess is good or bad. So it becomes volatility, implied volatility becomes a tradable thing because by its nature, it is not 100% accurate. It is accurate to the price of the option, but it is not accurate based on how much you think the stock is going to move over a period of time. It's telling you what they're paying, the market's paying, but that number might not be accurate or might not be close to being accurate. It can be literally anything in the future. Now, here are just some, quick issues with implied volatility. In general, when people are worried, traders are worried, whatever, implied volatility rises. And that number might be, like I said, it might be higher than the actual volatility from now until expiration. So remember, implied volatilities might not be the right vol to describe the forward vol between now and expiration. That's the idea. That's the tradable part. Again, they usually are too high. 3 to 4% is kind of an average number, which is why there's a lot of literature about what? Selling options, because there's the VRP, volatility risk premium. Right? Everybody thinks it's just free money. That 3 to 4% that's too high, I'm just going to sell options. It's going to be the easiest money ever. Doesn't always work that way. But that is where the basis for that kind of trading comes from. Options are overpriced. You sell them, you make money over time. Not that easy. Now, another thing is because instruments have many strike prices, all of a sudden you have multiple volatilities for one term. What's the right one? Who knows? And again, bid-ask spreads that are really wide can throw off the implied volatilities. So while it is a gauge for the number, there are potential inaccuracies, right? Because remember, what's it trying to do? You're trying to use the implied vol and predict the forward vol. And it might be right or it might not. But these are all things that just on the outset could make that number, that implied volatility off. Again, makes it a tradable thing. Historical volatility or realized vol. You'll see both of those terms just to make it more confusing. Historical or realized vol. So how much the stock has moved over the last time period. So people like charts. Why? It gives them context. The stock was there. I think it's going to go there. Volatility is, okay, well, the volatility of this stock has averaged 20% over the last 10 days. That's giving you an idea of how much it's going to move to a pretty good degree, right? You just use the calculation we showed on the earlier page. I got a 20% volatility average for 10 days. Okay, it's going to give me a range of what I think the stock is going to do. Maybe buying those crazy calls isn't the best idea because it's so far outside of the range that it could move. So again, giving you reasonable, like what's a reasonable move for an underlying? So 10, 20-day, 30-day vol. All that says is I'm looking at the last 10 days of volatility, the last 20 days of volatility, the last 30 days of volatility. That's all that says. 10 and 20-day has noise. I find it useful for option trades that you're going to put on and probably carry less than 2 weeks because you get an idea of how the thing's moving, whether you're selling options or buying options. Again, what I tell students mostly is you don't want to create a trade that walks into a buzzsaw, meaning you're buying options that are too expensive or options that are too cheap, or selling options that are too cheap. Now, calculating volatility. A lot of ways to do it. Also, and I realize I'll just say this at the end, but I misspoke a little bit on the range. So again, range is double the standard deviation. So when I gave you those numbers before, like 15 points and 30 points, the ranges are going to be double that. Sometimes I forget stuff. Anyway, so here, when you're looking at calculating realized vol, the idea of realized vol is close to close, meaning I have a closing price, and now I have the next closing price. So it's the 24 hours, the difference in price between the 24 hours. So that's what you're measuring with realized vol. It takes this calculation. Now you look at this calculation like, Andrew, that's not helping me at all. So 252 is number of trading days. Remember, we're using 256 on the back of the envelope volatility because it's square. You can take the square root of it easily. So it's not exactly accurate, but it's pretty close. Close enough as a retail trader. I use it all the time. Works fine. But if you have something like this, what I want to show you is, so if I have so here's a sheet with a couple of prices. So here, this is, I believe, here's the calculation. So this is the calculation that equation that I put up there. So if yesterday's close was, 125, and today's close, right, or yesterday's close was, let's say 120, I have a $5 move close to close. That's a 64.8% volatility. So again, that $5 move is a 64% volatility for 1 day. So what I'm trying to get you to see is you have an underlying move. The formula is doing the calculation for you and saying, hey, that $5 move, that 1 day volatility, the close to close vol, is a 64 volatility. Now let's put this into perspective, let's say, of the S&P 500. So the S&P 500, what was it? 521 yesterday, and today it's 522, just for instance. Okay. So if you have a 1 point move in the SPY, close to close, it's a 3% volatility. And when I write this up right now, VIX is trading at a 13 volatility basically. So if we have a $3 move, a 5, 2, 4, that's a 9 volatility close to close. Frank's not paying attention to the schedule. So, Frank, dude, wrong time. Anyway, so hold on. Frank, I'm doing a presentation, dude. That's all right. It's all right. We can edit that out. Hold on, let me get a pencil. You can't do anything here. Frank is our he's one of the my colleagues here at Option Pin. Anyway, so back to like forward vol. So hopefully you're getting an idea of a $3 move is equivalent to some kind of volatility. So hopefully you can get that part. So the whole idea is, all right, a stock moves, it creates a volatility. This is creating a volatility for one day. That's all. So when you see the VIX trading at a 16, okay, that's roughly going to be, like I said, 1%, right? So 1% here would be about $5. So this will be 526. And your 526, again, roughly 15.16 vol. Very, very close. Okay. So you're getting the idea of that's a little, again, we need to be a little bit more. That's a little less than 1%, but it's relatively close. So again, you're getting the idea of what a 1% move means. All right, I got to scoot this down here and do this over here. All righty. Oh, got to get rid of that. There we go. And there we go. All right. So again, I gave you what I would say is the one-day calc for that. You could use, doesn't matter what the price is. Again, doesn't matter the price of security. It's going to give you the volatility of what the move is. Once you start, so again, when I was a floor trader, I didn't even talk an underlying price. All I talked about was vol. I'm trading a 5 vol, a 10 vol, a 20 vol. The underlying price really didn't matter to me because all I cared about was a relative vol level. As retail traders, we care about price because we think the stock is going to do something. It's going to go up, it's going to go down, whatever. But using volatility is going to help you see how the options are being priced for a move and whether you're getting a good deal or not. Another example of vol is average true range. And what you're getting is, but what you're really doing is the high tick and the low tick from yesterday. So what was the high tick and what was the low tick? That gives you what, again, called the average true range. We use that. It runs and return in a natural log, just like the traditional realized vol that we just did. Again, it can be a leading indicator, meaning what? The true range is big. The intraday is a big number. Why is it moving so much? The intraday really small and shrinking. Why is it shrinking? So when you're looking at trade, okay, that ATR is shrinking. Stock is getting less active. ATR is growing. Stock is getting more active. Again, might help you with directionally, okay, if the thing is kind of coiling up, you don't expect a lot of action, could be a better option sale. All of a sudden, those ATRs are growing, maybe an option purchase. So sort of seeing how the stock is trending from a vol point of view could help you with directional or whether you want to buy or sell options. Now here at Option Pit, we have tools to evaluate volatility in every part of the spectrum. This is not an ad for Option Pit, but we use all the tools we sell. At least I do, Mark does, Leisha does. So the idea is here, I'm looking at ATR and realized vol. So you can see that the range in volatility, and this was for Apple, I believe, the ATR is slightly different than the close to close, but they're very close. We have a 39% versus a 30% vol, it looks like. So what's happening here is this, to me, says that Apple isn't doing a whole lot more than the close to close, which is generally kind of a stock that's not, it's on its way to not doing very much. When you have that kind of high ATR, you know, that usually means there's people are coming in and buying it or buying it up or selling it down. Right now, they're just not doing much of anything. That's how I look at that. So the idea of ATR, using it, we actually calculate it and help use ATR to help and see if straddles could be a purchase. That's buying calls or puts, buying strangles, buying options in general. Because you have an idea. Once you have that ATR number, you now have a range. That range creates a vol, a realized vol, how much the underlying is moving. And then you know when you're buying options, if you can expect those options look relatively inexpensive or not. It gives you a starting point for a trade. You know, a lot of what students ask is, well, how do you know it's a trade? Right? I look at the vol first because I want to know if I'm going to get some kind of a deal or not. Is the market giving me anything? As you learn how to trade, how to learn to trade volatility, get interested in it, you will start to understand how it works a little better. So expected range, the straddle. The straddle is just the call value and the put value, right? That little blue line across the middle of every screen you're looking at. Every option screen has the straddle, which is what the liquidity provider thinks the underlying is going to do most of the time to expiration, meaning 68% of the moves should be, you know, if I look at the 172.5 straddle, it is $6.85. So that means $6.85 or less will hold most of the moves. So that's 685 up, 685 down, just like the initial example we have on like slide 2, but the total number there means the range is going to be twice that number. Again, just going back to that, my little brain cramp at the beginning, right? Your straddle value is 685. That means 685 up or 685 down, but that range, so the range then is now double that number. So that tells you what most of the time the liquidity provider or the market itself, because the market's setting the prices, right? Because they're buying and selling them, what's going to happen? So you're like, I don't think Apple's going to move $7 between now and April expiration. Okay, that could be a reasonable bet. But you can think of it as like, if you see that implied volatility number right next to it, we're going to go over that. You're basically saying I'm going to sell a 19 vol in Apple. So you start thinking of it like that. If you sell that straddle, you're selling a 19 vol. That price equates to a vol. And you might think 19 vol is high. Fine. But that's what you're doing. When you sell that straddle, you're selling a 19 vol. That's selling a call or put. This is not a recommendation for a trade. So pull yourself back from the edge and don't go whack out a bunch of straddles at a 19 vol. Okay? So is this accurate? I don't know. Historically, myself, the straddle is an idea to start, but if it was 100% accurate, trading wouldn't be very exciting. Sometimes it is, sometimes it isn't. As you learn to trade, you'll start to gauge that better. Now, understanding what is log normal. So we're going to do a little bit more geeky stuff here for the last 20 minutes, understanding the things that go into the vol. And I remember I'll take questions in the last 5 minutes. So most traders assume that stocks have a log normal distribution over a long period of time. Meaning what? That upside variable is higher. And mostly because stocks pay a dividend. So, at the end of the year, Black-Scholes assumes stocks should be higher. That is in the model. So when you're looking at volatility, looking at option pricing, the model assumes stocks are going to be worth more at the end, and there's a continuous compounding to a stock. If you're an investor, you understand what that is. Boop, 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 stocks go up. The model uses this approach. That is in the Black-Scholes model. That was the original model and how they figured it out. Now, the difference is stocks don't always move like that in the short term. So the idea here is, again, practical continuous compounding is nice, but how is it exactly what happens in real life? Maybe year over year over year over year, but not in the short term. It doesn't, the distribution doesn't look like that of moves. So what the market does is it skews the option prices. Okay, so because of supply and demand, what happens is you don't have a flat volatility, right? So if Black-Scholes was writing a volatility curve, it would just be a straight line, a straight horizontal line, just one vol for all strikes. But that's not actually how volatility trades. It prices puts more below, so it's already charging you more for puts at the bottom and generally charging you less for calls that are just out of the money. So the market is already adjusting for the assumptions. Now, this helps make trades because, like I said, there's only going to be one average volatility between now and expiration, which is, again, another reason why people like selling puts, because they're likely going to be more expensive than the average vol going to expiration. When I say vol in this context, it's volatility, not volume. Right? And again, because every strike has a different volatility, it throws out the actual normal distribution, right? That's this blue curve here. Just what a normal distribution is. And you have a different distribution. Again, here's like a little fatter tail on the downside, right? Because of the market falling apart. And all of a sudden, all those options are more expensive. So it brings into a host of different type of option trades because you have different volatilities to go sell. Butterflies, diagonal spreads, different types of calendars, all kinds of stuff can be traded because there's a little bit of skew in the options, right? Anytime you buy low and sell high, basic option vol strategy, it's really pretty simple, to be honest. Buy the stuff that's cheap and sell the stuff that's expensive. Don't make it a whole lot harder than that. But the skews in the option, the different volatilities per strike, are what allow better trades to occur. Types of skew, right? So I would say investment equity skew, so indexes, IBM, any kind of equity. Commodity skew generally is cheaper at the money, and both the calls and the puts are more expensive, or the upside commodity stuff is expensive, like VIX is another example. Breakout skew is when everybody's worried just about a melt up in one way. So generally, the idea of skew is more expensive where everybody is worried. Like people worry about running out of wheat, so the skew is going to be higher there. Okay. So again, commodity skew here, like all those options, very expensive on the upside. I believe this was silver at the time. Okay. Oh, or this is VIX, right? So all the options up here are at higher volatility, all the options close to the money are lower. So the skew is where the fear is in general. Breakout skew. So you have relatively low vol at the money, and you got the more U-shaped, right? Gold. There's that upside breakout in gold. Everybody's freaking out about the dollar, whatever, or inflation. So they're going to price those options higher. What that does is that gives you spreads that are relatively low dollar prices. So it helps when you structure a trade because you're getting a volatility, what I call a vol edge. A vol edge is just buy the cheap stuff, sell the expensive stuff. That's it. That's all vol edge is. It just happens in many, many forms. Lastly here, equity skew. Most, not all, are going to look like this. Meaning you have a higher vol for a put out of the money, which is over here. You're going to have a relatively lower vol for at the money. And then those upside calls that buy riders, people like to sell, are going to be at a lower vol. So most skews are a result of supply and demand. Now, again, skew moves in what I would call a non-uniform manner, but it does have patterns. What I will say is index skew is relatively uniform and tradable, at least in the SPX, Russell, and the NASDAQ. What I say here is vol can move different ways. It can increase slowly. It can increase quickly. It can decrease slowly. It can decrease quickly. Skews can move from the money, at the money. What I can do is I can give you an example here real fast. Okay, so if I pull this out, so you have it's got a skew chart here. So there's there we go. All right, now I'm going to have some curve here in gray. Looks like this. Okay, there's our vol curve. Now, what can skews do? Well, they can, right? The whole line can move up. Okay, the whole line can move down. Okay, so this is what I would call, this is the volatility uniformly moving up or down along the curve. Okay, you can also get a very steep move, like puts blow up. Call volatility blows up. Now, recently, because of the demand in AI stocks, you're seeing a curve that looks like this, moving up. People are paying up for these upside calls. So as a trader, you can buy stuff at the money and you can sell the out of the money stuff. You get cheap spreads. Cheap spreads with low decay. That's why skew is interesting, because it gives you trades that allow you to hold them for a number of days. And the decay factor is really, really small. It's all stuff you can learn. Right? So those are some examples of how skew can help you. Lastly, here, we're just going to touch on the idea of term structure a little bit. Basically, every term, every weekly, every monthly, every daily has their own vol. When you trade one volatility against another in different terms, you are creating a calendar spread of a sort. The terms are correlated, the volatilities are correlated, but they're not going to move in lockstep together. They're going to move on a slight ratio. Again, there's a lot of nuance to trading term structure, which we cover in a lot of different places in Option Pit, OP Mentoring, Trading Desk, stuff like that, Pro. Just to let you know, though, that you're going to see different volatilities in different terms. And as time goes on, the slope of those curves give you information. So the basic structure is this. All right, here's the basic structure. You're going to have a flat curve here. That's the market expecting, I know it sounds weird, but the market is expecting a little bit of action. There's some uncertainty there. Okay, you have an upward sloping curve. Whoops. Let's get rid of that. You have an upward sloping curve. That means the short-term volatilities are high relative to the back month. The market is expecting huge short-term gyration. And then you have a downward, what's called contango. The other curve is backwardation. And a contango curve where the market is not expecting a lot to happen in the short term. So this contango, flat, and backward curve. Again, this is just just giving you an idea of how things work. It is not everything in terms of term structure, but these are different things to trade. Okay, ready? Front month options will, right? They're going to move in IV terms the most, but they're going to have less sensitive implied volatility in dollars, meaning short-term options are going to have big changes in volatility, but smaller changes in dollars. They're going to have the steepest skew, and that is a function of several things, mostly because implied volatility per dollar is relatively small in short-term options. And again, they're generally in contango, like I showed you, because the market is looking for less movement in the short term unless things change. Okay, back month volatility, options in IV, right? IV moves not as fast the farther out you go. You're going to have flatter skews in general. So that skew trade is less pronounced. They're more sensitive to an absolute change in vol, meaning a 1 or 2 point volatility move 3 months out is relatively large. And again, mostly you're in contango unless the market starts to blow up. Contango being that red curve that I showed you. Now, implied volatility, when you're looking at a screen, somebody asked before, how did you get that volatility number? Well, it's printed right here on your screen. Almost every platform has implied volatility printed right here on the screen. Right? So if I'm looking at it right there, it's implied volatility. It is calculated and posted for you. So here you have 3 basic ones. You have your sigma vol, volatility at the money, and then you have your 25 delta, which basically is what I'll explain that in a minute. Why are they important? So these are giving you implied volatilities that are useful. So you have your implied volatility of the 25 delta, you have your implied volatility at the money, and you have your average volatility for the term, which is also known as sigma. Now, sigma volatility, again, uses a little skew. It's a collection of volatilities at the money, out of the money calls, and out of the money puts. It's kind of like an average vol for the term. So it does use skew. Your straddle volatility does not use skew. It's just the implied volatility of the straddle at the money. Your 25 delta vol, 25 delta options are generally at the edge of the straddle. That's why it's useful. So you're getting the individual vol, the difference between the out of the money put and the out of the money call volatility at a 25 delta. Why do they pick 25 delta? Because it's basically a straddle width away from the money. If you don't know what delta is, it's the percentage change of an option with a $1 move in the stock. Now, there's multiple definitions, but it's basically how much your option is going to move if the stock moves $1. That's what your delta is. So these are, again, little screen reading tricks. So when you look at the vols on the screen, it is helping you estimate, again, this is what the market thinks the vol should be based on price. All right. Now, again, this is just the beginning of options. So there's a couple of questions I had in here. VIX skew is the reverse of SPX. Generally, yes, because upside VIX is the blow up, not the downside. Let's see here. What was the relationship between VIX and SPX vol? So generally, as far as skew goes, you've got an upside curve in VIX. The calls are more expensive because that's where the blow up is, and puts are more expensive in SPX. Let me see what else we got here. Again, why do we use trading days? Because trading days are what we're trading. So you can have a volatility based on calendar days. Fine, you have a calendar day volatility, even though, 100 days are not tradable or more, 110 days are not tradable out of that, versus the realized vol. So realized vol is basically like, okay, I've got 10 trading days. What's the vol? Right? You don't care what's happening on the weekend. Now, we teach you to price volatility over the weekend. But again, understanding basic vol. So here's a question. Straddle showing a 19 vol, but HV is showing a higher vol than the trade as the. So basically a question is this. Your straddle is showing a 19 vol. The realized vol is showing higher than the straddle is mispriced. Exactly, MM. Then you have a trade. Now you decide what you want to do with the straddle. You know, now you decide what, okay, I think the straddle's a buy. Now you trade it. Like I said, at least you know you're not walking into a buzzsaw. If the underlying vol is higher, it's harder to sell a straddle and make money, right? Because that range of the underlying is bigger and the stock just rips outside of the range and then you lose on your straddle. So the idea of looking at the pricing like this in a, what I would call a rigorous way is going to help you with the type of trades that you want to put on. You're just not throwing darts on the wall all the time. You're understanding the kind of the theoretical underpinning, right? Which is essentially just basic statistics. Again, any questions? 888-TRADE-01 for Option Pit. We'll be happy to help you. All right, bye-bye.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.